I am at risk of boring you into thinking that IPOs are not fun. We've got a little investment community over here who saying, well, we don't invest in IPOs. But honestly, I don't know whether it's my having a cold or the need to do all of this on a very sunny Sunday afternoon, but I promise you that IPOs are much more fun than what I am presenting to you today, but we just need to get through some of the detail. The colours on this slide clearly need to change. I might do that as soon as I finish. I just wanted to point out that ASIC have issued a regulatory guide. Again, it's going to sound like I'm segueing, but these things are here for you on purpose. If you are working as an M&A lawyer or any kind of corporate lawyer, you are drawing on, as you know, contract law, and you will clearly be looking at the corporations law quite a lot. From time to time, you go and look at tax laws, you'll go and look at competition law, a range of other things. But it is very easy for us when we think about how we would actually practice to just imagine that there's a Corps Act and that's where we would stop, and then maybe we would go to the regulations. ASIC, massive regulator, also provides regulatory guides, information statements, and a range of other notices that can be really quite helpful to understanding how ASIC applies the law. So again, if you are looking at putting together a prospectus, or really if you're looking at having to deal with any significant component of the Corporations Act, one of the first things that you would be wanting to do is get onto the ASIC website and have a look and see whether the regulator has provided any guidance as to the way that it's going to apply or it intends to regulate the law. The other thing is with Chapter 6, which is where most of the requirements in relation to share issues come from, or securities issues comes from, ASIC has some powers to waive the application of the law in some circumstances and to modify the way that the law applies in relation to some circumstances. And the regulatory guides will tell you how they do that. So regulatory guides can be really useful things. As you're working through assignments, you might find that it is worthwhile having a look to see if there is guidance about the areas that you look at. So from an academic perspective, we don't tend to think about guidance because that's just what the regulator says, and the regulator is regularly a party in matters in courts where judges decide what the law means. So it's not for the regulator to tell us what the law means. I'm just, trying to pretend I'm an academic, which clearly I am not. From a practical point of view, most of us don't actually want to end up in court. So if we can find a way to do it that's consistent with the way the regulator thinks that we should do it, well, that seems to be a pretty good thing as far as I'm concerned. Other regulators who regularly issue guidance, that's a bit of a tongue twister, include the ACCC and the Tax Office. And it can be something that when you go into practice, that the lawyers that you work with are now very used to going and looking at those things, searching them out, but because you've been studying law as an academic discipline, you might not necessarily think to go there. And so in this subject, go there. Have a look at whether there is regulatory guidance and how it applies, because that's how I work out what the law means too. Secondly, there are some really smart people who work with the regulators, and it is their job to do this day in and day out. And they have read the judgments, they have thought about these things, so they are actually usually very well written and cogent pieces of information. I may not always agree with them, or I may not want them to regulate it in that way, and I might see an alternative, but at least if I can see the guidance, I've got a basis for understanding the approach that they're taking. So in Regulatory Guide 228, the focus of this guide is looking at how to write a prospectus. And it basically requires, the guidance is that it needs to be clear, concise and effective. It needs to help retail investors make investment decisions. So ASIC pretty much approaches this the way that I do, which is, what is the law for? These laws that require us to do these things are asking us to do it so that investors can make informed choices. And an investor who's presented with too much information, particularly if some of that information is irrelevant, can't make an informed choice. ASIC says that best practice involves highlighting information, so providing that investment overview. Since that's been in there, those investment overviews have been right up the front quite regularly. You'll remember when we flicked through the prospectus, we saw an overview and it included links to the more detailed information. A prospectus should contain a business model. So in other words, it should give us an understanding of how the company is going to make its money and how it's going to generate income and capital growth. It is, if you read a prospectus as an intelligent person and you don't understand how the company is going to make money, then chances are it's a crap business model or a crap prospectus or a little bit of both. And it needs to make clear up front what are the risks associated with the business model, the security and the offer. The thing that I think often gets missed in the commercial discussion is risks associated with the security itself. Are there voting risks? Are there dividend risks? Are there issues associated with the security? Now, with ordinary security, it's pretty straightforward, but when you're listing something that is more complex or seeking to quote something, to be precise, then that's something that you need to think about. Needs to include the financial information that shows the financial position, performance and prospects. So they're the words that actually just mirror what the section says. When it comes to directors, it needs to include information about their interests, the benefits and the related party transactions they've been involved in. So if the company has bought something from a director, or a director is key to getting something done, if a director is related to a supplier or to a customer or has some sort of influence over either, that's something that needs to come out in the prospectus. Do the people in control have the appropriate expertise and who will benefit from them being in there? That is a question that ASIC expects to be answered by the prospectus. That if there is something extra or special that somebody in control is going to get, if there are benefits that third parties are going to get, identifying those third parties is an important element of preparing a prospectus. And ultimately, and this kind of, you would think would go without saying, but it needs to be clear what the terms and the conditions of the offer are. What is it that you are paying for exactly? What dates do you have to do things by? What happens if it's undersubscribed? The terms of the contract need to be clear in the document itself. Given that we're talking about ASIC, I think it's a good idea to think about what ASIC's role actually is. So ASIC ultimately regulates the offer of the securities. So ASX is the platform on which you list, and the securities, when they're issued, will be quoted and traded. But ASIC's role here is to regulate the offer itself. So there are a couple of things that it does. Before you can make an offer to the public with a prospectus, you have to have lodged that prospectus with ASIC. They can refuse to receive it. Like, they can literally be like a toddler, close their mouth and their ears and their eyes and say, no, I can't see you, go away. The grounds for doing that will include the opinion that the document contravenes the Act. Okay, so they can refuse. Unlike ASX, who will have a chat with you before you go into the listing process, ASIC will not have any pre-lodgement discussions with you. They will not give advice. They do review prospectuses, but they might not look at all of them. So when you actually lodge a prospectus with ASIC, you will not know whether or not they're even going to look at it. Again, like all of the regulators, they're getting smarter at what they look at. My guess is that they are looking at cryptocurrencies, hemp and small tech companies more than they're looking at, I don't know, standard explorer mining companies or retail businesses that are spun out, they almost invariably will look at the very big ones because they too have reputational risk if something slips under the net. I think I mentioned earlier that they actively encourage competitors, people who are unhappy with the transaction, to contact them and tell them things that might be wrong with the prospectus. If there's a concern of any type, they can seek some kind of corrective disclosure. So again, disclosure underpins the whole of this regime. So effectively, a corrective disclosure means issuing a supplementary prospectus. It's not uncommon to have multiple supplementary prospectuses. Supplementary prospectuses can happen because the environment happens, or because ASIC is asking you to correct something, or you yourself find something that needs to be corrected along the way. Of course, market doesn't respond well to corrections. Okay, so even though ASIC actually requires the inclusion of a statement in a prospectus that says that ASIC isn't responsible for this statement, that the document has been lodged with ASIC on a particular date, but that they take no responsibility for it. The reason for that is, I believe, is that many people think that if it's a regulated document, then the regulator has made sure that it is right. So in previous regimes and in many countries in the world, in order to get a prospectus out, you have to lodge it with the regulator, and the regulator goes through and checks that it is correct or it's right. A bit more like the ASX form thing, although ASX takes no responsibility either. The people who are responsible for a prospectus being true and correct are the people who issue that document. ASIC can also has powers to ask for more information. It can conduct surveillance. In that report that I quoted from earlier, they say, based on our experience, where a prospectus is defective, it's often the case that the issuer cannot demonstrate that appropriate due diligence and verification procedures have occurred. So on a small number of the prospectuses I've been involved in, ASIC has done random checking. Effectively what that is you get a call in the morning saying, we're coming around to have a look, can you have a space for us and documents ready? I have heard that occasionally now they ask you to come to them. On one occasion that literally was 2 hours. They came in, it was in a law firm environment where I was the partner on a particular float. They came in, we gave them the boardroom for the day, they asked us questions, we brought them verification information, we gave them a verification file to have a look at. They were out. It was just clearly they weren't looking for anything in particular. Clearly we were just the one that they were looking at. On another occasion, they spent 3 days going through a range of different issues. Again, that was another one where I was acting as opposed to being involved in the float as part of the issuing team. They were, again, in that state, they'd been tipped off by a competitor who disagreed with the way that this company had, it was actually a financial question, and I think they didn't like in the accounts the way that they had accounted for subscription amounts. So it's a relatively technical issue, but the extent to which if you receive prepayments, you can actually count that as money that belongs to the company as opposed to, the term is from memory, unearned income. And there was a particular basis on which that calculation had been done. In the end, they were happy with it. They had a couple of meetings with the auditor. They looked at the information. Again, because we had a robust due diligence process in place and there were different ways of dealing with that issue. On one of the ones that I did myself, we had ASIC come in to have a look, but it was, again, that was in relation to Domicom. Again, look, they spent a little bit of time looking through accounts, and partly their concern there was that the company, one of the assets, it wasn't actually it wasn't billed as an asset in the sense of a financial asset, but one of the benefits that the company was saying that it had received some particular waivers from ASIC in relation to some of the financial services rules for a particular financial product that it issues. And ASIC didn't take well, not surprisingly actually, on reflection, to it potentially looking like ASIC had endorsed this product ahead of other financial products. But in the end, the ASIC float team, so a different team from within ASIC, so we were actually ASIC dobbed on to ASIC on us. They came in and they didn't think that it looked like an endorsement, and there was, by the way, seeing I am recording, ASIC certainly does not endorse financial products any as being better than others, although it will, once they're approved products, it will say a dodgy product is a dodgy product and you shouldn't invest. And by the way, if you've never looked at the ASIC Scammers website, it is worth having a look at. So, if they come into the room and they look for things, what kind of things do they look like? There's a regulatory guide which will focuses just specifically on what they look at in forward-looking financial statements. But generally they look at things like, does the prospectus actually highlight the important things that will help investors make investment decisions? They'll check that the prospectus itself doesn't deflect attention from the key risks, so it doesn't dumb down or hide away key risks and make sometimes, back in the early days of this regime, which is really early 90s I'm talking about now, risk statements tended to be written in a way that it's like, you know, a bit like really bad job interview questions. You know, what's your biggest weakness? Oh, look, I'm just too honest. There's, you know, a big weakness here. You know, there's a big risk that because our product is just so good that we'll be overrun with people wanting it and we'll have to put our prices up. You know, that kind of dodgy reverse risk stuff. They really, really don't like that, and good on them for it, I say. But they will also look at the way you've worded it. If they think that you've been too long-winded, that you've hidden things away in verbosity, that can be an issue as well. Also, to the extent that you incorporate disclaimers, so things to say what you haven't done, they will be looking to see that they're consistent with the liability regime. So, supplementary prospectuses are one thing, stop orders are another thing altogether. So if ASIC considers that there is a serious defect, so misleading or deceptive information or the omission of something that is material, ASIC can issue a stop order that will prevent the company from offering, issuing or selling the shares whilst that order is in force. It is more common for ASIC to request a supplementary prospectus, or for companies to jump in ahead of ASIC even asking and getting that supplementary prospectus out in relation to minor issues. If new information comes to light after the prospectus has been lodged that results in a change or results in the prospectus no longer meeting the test that it did meet at the time that it was actually issued, then a company is obliged to issue a supplementary or replacement prospectus if that new information is materially adverse from the point of view of an investor. So good news that comes in, you don't have to do anything very much. You might want to, but you don't have to do anything. Bad news, or realising that there is a mistake, if the impact there is materially adverse to the investor, then you need to issue a supplementary document. So I want to talk a little bit about, once you've got your prospectus out in the market, what actually happens. The one we looked at today was, and I hadn't really looked around to see if there were any more complex one, was pretty straightforward. They were offering ordinary shares plus some convertible notes plus effectively some performance-based shares to the insider team. That's quite common. You can have them even more simple than that, just ordinary shares, not uncommon at all. And you can have something that is much more complex, especially when you've got bigger companies or either large private entities that are going public. So insurance companies, for example, that used to be mutuals held by their members that are then converting into public companies, or spin-outs of large, so One Steel, BlueScope would be good examples of companies that span out of a larger resources company, BHP in that case. You'll often end up with different kinds of offers. So you'll have an institutional offer that is specific offers that might even be made before the public offer is made, to subscribe as part of the larger offer, and effectively these institutional offers sort of replace or augment the underwriting. These kind of offers will normally have an underwriter as well. The overall fee will be much higher for that underwriter, but the percentage is usually much lower at this end of the market. There'll be the retail offer, as it's called. That is your offer to the public. And sometimes they might also incorporate a priority offer. So in other words, you might give, and Maya did this a couple of years ago, it gave priority to people who held their loyalty card. So when their prospectus came out, if you had a loyalty card, you got to lose your money with them faster than ordinary people did. As it transpired, I had the benefit of hindsight, right? So prospectus, the offer itself can be quite complex. Another thing that lawyers often get involved in here, and we need to be really aware of, is that there are really strict restrictions on advertising that there is an offer or there's going to be an offer before that prospectus is available. There are some things that are allowed. So before you have a prospectus, you can undertake roadshows. So these are confidential meetings with people who are sophisticated, who have financial services licenses, where you can give them information about the upcoming offer, but you can't actually make any offer there. You can publish market research about your company, and you can publish or make available independent reports about the company, but you can't go around saying, we're going to list next year, get yourself in line, it's going to be a great deal. Basically get people interested, and you particularly can't take their money before they have a prospectus that has been lodged with ASIC that they can have a look at. So ASIC, so this is actually just a report, 949 from September 2016. So again, ASIC issue lots of different documents. So a report, the weight that you might give a report is something less than what you would give to a regulatory guide, for example. So in this report, ASIC outlined some findings of a review that it had done with marketing practices, and basically gave the industry a bit of a black mark, actually. It saw that traditional marketing, that going around and talking to people remains really important, but they were expecting social media to be quite important, but those who are involved in the issue of prospectuses are kind of wary about the extent to which social media might impact their own liability, and because they can't control it. So basically they've left social media for elections, I guess. One of the concerns that they had is videos. There's a lot of video stuff that's being made about companies and their benefits. Domicum does a bit of video. I really don't like it. It looks like dodgy real estate agent stuff to me. I just think, no, why are you doing it that way? But this is why I don't work in the business anymore. But one of the biggest risks that ASIC see there is not that you can look like a dodgy real estate agent, but it actually can be really hard to update it and to change it. And once something's actually out there on the internet, it's very hard to control unchanged and unedited versions. So what do they say? I think I've got a quote from the report in here. Overall, ASIC saw some good marketing practices, with sample firms having systems and controls in place for marketing, with oversight of marketing by larger firms being more robust. ASIC has identified some areas of oversight weakness, misleading communications and inadequate controls on access to information. So in particular, their concerns were about telephone calls, so brokerage firms that are going out and cold calling people without properly briefing brokers. They still see that as problematic. I'm not sure what they can do with that. So they recommended some best practice again, making sure that there are detailed records, good telephone scripts, and maintaining records or recordings of calls that are selling shares. Marketing shouldn't be on the should be on the merits of the investment, not on, remember last time I put you in front of this, you made a bit of money, or you've missed out on the last 3 good things that I've done, this is the one for you. Information that's given about forecasts needs to include all of the underlying assumptions and qualifications. So make sure when you're telling people that you are marketing an issue to, where if we're projecting $1 million of profit, actually identifying where that projection comes from. Yeah, so I think I've mentioned the others as we've been going. So another report that ASIC did in late 2017, I found this really fascinating. They looked at what investors actually look at most closely when they're deciding whether to invest. They also looked at whether institutional and retail investors placed the same or different weights on the kinds of information that they had, and they tried to identify whether retail investors really understood prospectuses. And ultimately they found that both retail and institutional investors look at the prospectus, but they both look at other information, and both sides want to have access to management, that they are more interested on the whole in who it is that's running the business than necessarily about what is being said. But there are differences between the way they look at the materials and the types of sources that they look at. So what have I got that's, yeah. So in relation to a prospectus, institutional investors say they value the prospectus because it's the main source of information that they have and it's a regulated document. Institutional investors like speaking to the management team. They want to do their own internal analysis, so they basically take the numbers and the other information that is in the prospectus and they put it into their own models. And they said that on the whole, investor education reports, so marketing materials, were of less interest to them. In relation to retail investors, most retail investors said they felt comfortable ignoring large sections of the document and only focused on the parts they considered to be most important, or the ones that they could understand. I find that really interesting. I'm going to ignore the bits I don't understand and make my decision based on the bits I do understand. It's very human.
Standard form contracts. You look at the things that you care about and the rest of it.
But again, look, I think Carly's point here is really absolutely right. There's lots. We are actually in an age where we don't look at the material anymore, right? I'm probably the only contract lawyer, a teacher in the country who regularly says, I'm clicking I accept all the time. Like, I can't negotiate it. I don't know what I can do. I want the thing. It's too much hassle. I've got an immediate need. I'm impatient. That's what I do. Yep, I'm crap. I admit it. If it's important to me, if I was buying a house or I'm apparently one of the only people who read from cover to cover the contracts with the private schools I sent my children to find out what the terms and conditions there were. Were remarkably interesting what they would disclaim from.
But most people who buy a house don't even read the full land sale contract.
No, and in fact there's some research that shows that most people, most couples will spend more time deciding the details of married couples, young married couples will decide the details of things to do with their wedding, like cake flavours and colours, dresses and flower arrangements, than they spend inside the house they buy or looking at the contract in relation to that house. There's some research that shows it's in the order of 10 times.
If only we can afford houses these days.
No, yeah, something like that. So yeah, there are, and I guess I want to bring this out because we have a whole regime that rests fundamentally on the way we're going to make sure that investors don't get ripped off is by making sure we give them disclosure. And at the same time, the research is showing them actually the people who in theory need the most protection aren't actually reading that document.
My key question here is why hasn't ASIC brought in reform to say, look, we will have the full prospectus, but we have to have a cover page with a traffic light report, you know, and you have to rate the risks?
So, well, firstly, ASIC is not the government, right? So actually getting changes to the Corporations Act is, as a logistical exercise, is quite difficult, particularly when we really haven't had a majority government now for a long time. And changing the Corporations Act, particularly in relation to these kind of things, really goes to, it really goes to the big and the small end of town. So the kinds of reforms that we've seen coming through over the last couple of years have been things like the CSF reforms, or reforms that relate to cryptocurrencies and the like. So firstly, that ASIC has, through its guidance, pushed for saying, okay, our understanding of what this law means, concise and precise, needs to have a summary section at the front. Doesn't say traffic lights, doesn't prescribe how to do it, but we are seeing more and more of those summary sections. And it's clear that retail investors are reading those, but the devil is often in the detail.
Governments love big policy things, so
Yeah.
things like crowdsource funding, that can get through Treasury, but in terms of when a Treasury agency needs a technical change to the law, there's no interest.
No.
Well, there can be interest.
And I think too, and I think this is, it's a more philosophical discussion in some ways, but we do have this, any of you come across an economist called Dan Ariely? So Dan Ariely is sort of probably the most well-known of the behavioural economists, and there's a lot of work that's been done in relation to behavioural economics over the last 15 years or so. He's a regular TED Talk person. Again, if you want some procrastination study, absolutely worth having a look at just TED and Dan Ariely. He's an Israeli guy, and he's written a book which is fabulous called Predictably Irrational. And basically we have this kind of driving economic force that sits behind our Corporations Act, it sits behind our Competition and Consumer Act, which basically is this understanding that the market will look after itself, that basically if we have more buyers than sellers, that prices will go up. If we have more sellers than buyers, prices will go down, and that the market is always trying to level itself to the middle, and so when there are more buyers, people will come out. The market ultimately will regulate itself. People make rational decisions, but behavioural economics is basically a combination of psychology and economics. Now, I don't know about you, but often the big decisions, as you've just mentioned, buying a house, is often a really emotional decision. It's not a financial decision that people make. Similarly with investments, people will decide things emotionally and they're led by other things. So, if the guy who is giving you investment advice turns up in a fancy car and has a really nice suit, you will listen, or most people will listen to that person differently from, and is this the barefoot investor guy? You know, if he turns up in jeans and scruffy shoes, actually modelling I'm being frugal and saving my money for the stuff that matters to me, but it's not portraying the image that is associated. So this behavioural economics, a lot of the decisions that people make are not rational, but a lot of what's happening now is these people are working out, well, how do we nudge you into making the decisions we want to do? So, and you know, that ranges from things like decisions about whether to give organs. So the TED Talk I like particularly of Dan Ariely's is, you know, you would think, so it turns out at the time that he did this talk that in most countries in the world, the curve, if you looked at people opting into organ donation, pretty much went like this. So in any given country, either 10% said yes and 90% said no, or 90% said yes and 10% said no. So there's this vast difference. There's not countries that sit in the middle. So he was interested in why these countries are so different. So you look at that, think, okay, well, the Italians and the French, you'd think they'd be pretty similar. In fact, they're diametrically opposed. The Danes and the Norwegians, diametrically opposed. Something like that. I will be quoting the wrong countries. I can't remember my own name today. So ultimately what the research showed is when people need to make a hard decision, they don't make a decision. So they go with the default option. So in countries where it's tick this box if you don't want to donate your organs, 90% of people are donating their organs. In countries where it's tick this box if you do want to donate your organs, 10% of people are donating their organs and 90% aren't. And again, it's like you would think, okay, this is a rational decision. This is a decision that you make based on your culture and potentially your religion, talking to your family or whatever. But no, it's a hard decision. Investing is often a hard decision, so we go with the default options. So again, a lot of clever work can be done to frame these documents in a particular way. And I think too, what's fascinating me now is there's a lot of conversation about what's happening with things like the Cambridge Analytica stuff with voting in the last couple of years, and the extent to which the information that people received over social media about particular issues could be manipulated in a particular way to affect the way that they think. I think we are a little bit crazy if we think we're only going to use that for voting. We are going to use that for a whole lot of different things, including people making investment decisions. So
the number of people, like I would read on Facebook in the lead up to the election saying, oh, it's Labor Party policy for this, it's coalition policy for this, and it just wasn't true.
It's just not true.
And like I have to be very careful because of my employment, but I'm just trying to tell people this isn't right.
No.
This is not. And they go, oh, isn't it? And you go, you honestly believe something on Facebook?
But yeah, look, I know I received a whole lot of messages telling me that I was going to have to pay an inheritance tax.
Yeah.
Like, who's going to leave me anything to start off with? And it's actually untrue. And then quoting statistics completely made up about things that were happening in the UK that were just not true.
Yeah, and then that the retiree tax.
Yep.
It's just all propaganda.
Until it comes through.
Isn't all politics propaganda, though?
Yeah.
But that's, I guess my point here is because we could go off track very easily, very easily go off track. But my point is here that we have a regime that requires giving people long documents. I was just scrolling through that document looking for what I want. I'm used to looking at those documents. I couldn't see it. It's a long document. It's a lot of information. You know, actually, this regime, and I'm getting it online. There's no way for me to even really verify it's the right one.
The thing that I find interesting as well is if you look at the one we looked at earlier, to get to the financial information, you have to get to about page 60.
Yeah.
Now, that's not right. That they've got this backwards. It should be right up near the front.
Yeah, but then other people would say, well, we should put the risks right up front. Lots of people are not, you know, financial literacy is not as high in this country as it possibly should be.
Possibly that's a manifestation of our superannuation system. People have money and exposed to every single day of our lives, and we've got no idea what's going on with it.
No. And again, that's an example of hard decisions. Sorry, Michael, I interrupted you.
But again, one thing that we need to remember is people who actually invest in the markets, they literally are gamblers. It doesn't matter how many times you actually mention all of these risks, they're not going to even look at it. You know, I've seen many cases that they look at a risk, but they still invest into the market, like all of those pennies. So it's just
And
a
I
big
think-
casino, in my opinion.
No, I think it is. I wouldn't say it's everybody,
No.
but there are kind of two kinds of investors when you think about it. And if you're taking your company to listing, what you are looking for is money to move your business plan forward, right? But if you are investing in the market, investors tend to fit into one of two categories. Either people who are genuinely interested in this type of business and they think that there is value in investing in one or more businesses of this kind with a view to making a profit in the future. So I would suggest that Warren Buffett is that kind of investor. So Berkshire Hathaway goes globally looking at different kinds of businesses, looking at synergies, picking particular industries to go in and for long-term investment. So time in the market as opposed to market timing. The other type of investor, the day trader, the speculator on the whole, what they are looking at is, if I invest in this now, is somebody else going to be prepared to pay more for it in the future? They don't tend to really care whether that's because of the way the business is going to work or whatever. It's just that, is this going to be more interesting? So IPOs, particularly back in the 80s, people didn't hear about them. We didn't have the same sort of information. So there was this kind of like, if you heard about an IPO, you were getting in at the beginning, and then when people knew that it was listed, they would come and invest later. So people who were investing at the beginning, I think there was a culture of, I don't care about what it is, I've just got this opportunity that other people don't have. And I think there is a bit of a culture of that.
In I don't want to go off track, but in US, like they've got these quant firms that they actually trade with computers. It's like you don't have people trading anymore. It's computers basically looking at the trend. As soon as it goes up or down, they short the market. If it goes down, they go long.
Have you heard about the competition amongst high-speed cabling?
Yeah, exactly.
Yeah.
So there is.
Microsecond faster
Yeah,
to execute.
exactly.
It's quite
Exactly. So it's just.
So, and I mean, they brought New York Stock Exchange down a couple of years ago now.
Yeah.
There's a couple of what they call flash crashes.
Yep.
So we're basically, because the AI is basically responding to moves in the markets, and if you can get enough money in and out quickly, then you can trade on these short moments. But basically, the algorithms just feeding off each other, and everything just went down, and they ended up having to halt the market because it was just algorithmic trading. There was nothing actually that was happening. So there are risks involved in investing on the stock exchange. And again, that might be one of the reasons why we're developing alternative ways, because at the end of the day, why most companies are listing is that they need some money to be able to grow their business, to achieve their business plan, to actually do the thing that it is that they set out to do. What else did I want to point out here? Most retail investors these days aren't using full-service brokers either, so they're not even getting professional advice. I'm one of those, I will say. I use E-Trade or whatever they're called this week, if I want to buy or sell something. And because at the end of the day, again, the full service broker is supposed to be giving you advice, but I think there's a lot of cynicism there in relation to full service brokers, because you know that they're getting paid on both sides of the transaction. And I think the Royal Commission last year, even though most of that was focused on banking, I don't think that that has helped the way that ordinary people think about the financial market. So often the ways that individual retailers, investors decide how they're going to invest actually comes down to what friends, families, colleagues, people who drive nice cars tell them that they should do. So have a look at the detail in here when you've got a chance. So ASIC's what ASIC has done with this now is to really continue to tighten that circle. So the primary concern that it had when regulating IPOs was to ensure that investors had sufficient information. So we're sitting on this disclosure regime. But even though it's generally, as I said, it's actually generally satisfied with the way that investors get information, its intention is to continue to enhance that approach and to continue to look for concise and focused disclosure. And looking more at the ways that marketing is actually occurring. So, pricing. How does, once I've got my company, very sad little company now with a few robots and some lemongrass tea sitting inside it, how do we decide what the price of shares will be when I take my little company to market? A common way to do this is a book build, to basically go out to the market and seek bids and to use that information to develop a price. Book builds can be used at the beginning, sometimes even before the prospectus is lodged, in order to determine a fixed price, or a range is sometimes specified in a prospectus. So often what will happen in the prospectus for retail offer is it'll say that we will offer to the public at the lowest, whatever the lowest price ends up being, and then they will build the book with the institutions. So institutions will effectively offer a chunk of money, up to X for no less than Y%. And when they get all of those offers together, they basically moderate them through to see what they can get rid of. Your offer is too low. Take in the highest ones, pull it together to end up with a common price. This is really in the large size floats. I'm quite sure that there was no book build in the little prospectus that we had a look at earlier. Another thing that is really important and rarely discussed in the commercial context, very important to the lawyers, is the application form. So the application form is one of the few areas in the prospectus that has specific prescribed regulatory requirements. So section 723 of the Act is where you need to have a look at what those disclosure requirements are in the form itself. And 724 sets out the choices that are open to a person making the offer if the disclosure document isn't met. And so, in other words, if you've got applications that have been received, at that point you can actually, if you've got a defective disclosure, you can just give people their money back. You can send them a supplementary prospectus and effectively see if they want to stay in, but you do need to give every investor the right to withdraw their application if you change the prospectus. So once people have actually applied so the application form is a bit like a subscription agreement, really. In fact, it is technically the subscription agreement. It's the form that the investor says, I'd like this many shares, I'm putting this much money in. Basically, the way it works in practice is at the time investors make an application for an IPO, they will also forward the funds. So the funds will sit there effectively in escrow until everything is complete. It's not done until it's all done. Remember we've also made a listing application. So by the time we're actually accepting funds for our IPO, at this stage we are also thinking about making sure that we've met all of the requirements for the ASX application as well, because they may have raised additional questions at this stage. We've applied to get a code allocated. We're probably sitting on that website so that other people can find our prospectus and have a look at it. The managing broker is holding the funds for us, sitting in a bank account somewhere. And one of the conditions precedent to the release of those funds will be that the ASX accepts our application for admission to the official list and for quotation of the securities that we're seeking quotation for. So the company is not allowed to use any of that money until all of those conditions precedent have been met. Then finally we get to the big day. There's my business partner Arthur and the lovely James Garrity, who is the head of company operations for ASX, has been in Melbourne, has been for a very long time. They actually put in a bell when they moved to the new building that they are in now. Australia has never had a bell, but because there's so much American pop culture about the ringing of the bell for the first trade, they just gave in and they put in this bell. They've even made it look old, which I think is hilarious. So basically, once the application is complete, and ASX have said, yes, you're admitted to the official list, they will set a time for the admission, so you're actually admitted usually a few days before, and then a time for the first quotation of your shares. And they have a little ceremony. They put on a little afternoon tea for you, or morning tea, as it's usually a morning tea. Normally, shares basically trade from about 10 in the morning till about 4 in the afternoon from memory, bankers' hours literally. So although it's all happening electronically, the market has periods in which it is closed. And so the market is open over those periods. The first day that a company trades, it usually trading will open about half an hour after the rest of the market, but it might be substantially later if there's a couple of companies going at the same time. Before the market opens, ASX releases information about that it's received to all of the brokers. In the old day, that used to literally be like a recording. They'd all pick up the phone and they would listen to it. Before that, the brokers' assistants would literally be in the pit. They would be listening in the stock exchange to that information before they made their bids. If it is of any interest to you, the reason that it is called a stock exchange is because before, as the methodology that was developed for the trading of shares, before that people used that methodology for trading stock, like literally sheep and livestock. And so next time you're in London, they've turned the original London Stock Exchange, which is a really beautiful building. It's been there for 800 years or possibly more, and they've turned it into a beautiful, it's got, those bars that they do and retail and everything. It's really quite lovely, but it's got all this beautiful tessellated floor, and the reason for that tessellated floor is because sheep and cows used to walk through it and literally get sold, and then the market evolved and we ended up buying and selling shares in companies. And of course originally it was small, so people would actually call out, I want to buy Bank of London, I'll pay £1 a share, up to $2,000, and then somebody say, oh, I'll take some of that, and they would have somebody, they used to call them chalkies, who would be up another layer, who would be, just as they did with the price of sheep and goats, would be writing down the bid prices and the offer prices, and when a bid matches an offer, then they would basically execute the trade. They still literally did it that way until well into the 1990s. Things that you see before digital cameras, but I went to uni in Sydney, and at the time the law school wasn't on campus. We were basically in the basement of a building in Phillip Street opposite the Supreme Court, and just word went around Sydney Law School like nothing was happening one day in 1988. And I didn't even know what was happening, but we all just basically walked down Martin Place and went to the stock exchange. And there was a crash that basically happened around that time. A number of companies like Elders used to be a blue chip company. It basically collapsed that day. Bell Securities, I think, might have been a bit later. Anyway, number of sort of well-known companies basically collapsed on that particular day, and literally hundreds and hundreds of people were gathered around the stock exchange just looking in as these poor chalkies were running from one end to the other, and people were crying and throwing bits of paper in the air, a bit like Trading Places, only actually real. Then into sort of the turn of the century and Australia has really led the way. It's something that we can be really proud of, is that we have led the way in automated trading systems. So there's a platform called Chess, which is, what does it stand? I can't remember what it stands for, but it's basically the underpinning of the platform that we use now and is used all around the world, that was developed in Australia. A friend of mine's father was on one of the original development teams, so I keep telling his children that they should be really proud of that, and they have no interest at all. But basically, these days, you go to the stock exchange and it's really boring. So that's why they're doing things like putting in bells. They put a few screens around so you can see where companies are trading. But the human element is out, and more we're looking at computerised trading itself.
Yeah, I went to Chicago Board of Exchange 10 years ago. It was, they were just feasting.
Well, at the Futures Exchange, because there's all sorts of codes that they use.
Yeah, and then I went there last year as well, and it was just boring.
So basically, all sorts of businesses can be disrupted. All right, I got 5 minutes to keep my promise to you. But I do feel like that's value I can add. The rest of the stuff you can read. I keep talking about, but not actually showing you what the liability regime is. And so I just want to touch on that. We've talked about all of these things, but I just want to bring it together, and I'm going to apologise for that terrible colour choice. So liability for a defective prospectus can be both civil and criminal. It can arise when a prospectus contains a misleading or a deceptive statement, if it omits information that the Corporation Act requires it to include, or if new circumstances arise and nothing is done about that. Who might be exposed to liability? Is that my next slide? Or yes, it is. So, good. So the people who are exposed to liability include more than just the company itself. So again, when we were talking about what a company is, and a company can sue and be sued in its own name, the company is the issuer of the securities, the offeror of the security. So clearly it can be responsible, but it is not the only one. If the liability attaches to somebody selling the shares, then the seller of the shares can also be liable as well. Directors of the company, this is one of the places where the law literally lifts the veil. Underwriters take on particular and special responsibilities. Lawyers and independent accountants, others who are named in the prospectus, generally take on liability for any statement that is attributed to them. So if you are a consulting geologist, for example, and you include some information in a report that indicates your comfort with the likelihood of finding oil in this particular desert, you take on responsibility for your own opinions. Other kind of actions you can be liable for include things outside of the prospectus. So if you say things, or if the management team say things during a roadshow, if they breach the pre-prospectus publicity liability provisions, they can be responsible as well. So there are, and I'm going to finish with this, I promise, a number of defences that are available, and this is where the importance of due diligence comes in. So ultimately, while if a prospectus is defective, then there is a liability for that deficiency, but there is a defence that you have made all reasonable inquiries in the circumstances, and that after making those inquiries, you actually believe that the statement is not misleading or deceptive, or there was not a material omission for the prospectus. And this is why we go through this arduous task of verifying that every statement has some fact that supports it, some evidence to support a statement of fact, and that we go through one by one statements of opinion and look to the people who are going to be responsible for that opinion. If it's a legal opinion, the lawyers. If it's an audit opinion, the auditors. Geologist or technology opinion, those people. Or if it's just a general opinion about what the risks are or what the company might do or whether a dividend might be paid or what the opportunities are, the directors, and we get those people to positively confirm, having made due inquiries, that they do in fact hold that opinion. As usual, I have a few other things to say, but I did promise that we would get to here, and we really have pushed through today. I will follow up possibly with some video material, but I will also follow up with a webinar to do some feed forward on the discussion tasks. So I'm going to put out a little survey for that. I can't do it before the end of this week. I believe that the policy is that we should not do any teaching at times that are not evenings or weekends. It is part of the whole JD process. So I will offer times that are evenings or weekends. But if any of you want to have a ring around and say, gee, a lunchtime would be good, I can also do that. But it'll be Thursday, Friday before I can do anything anyway. And I think you've got enough to do, and I want to do some feed forward on assignment tasks.
So we have a pick of 1 of 5 topics for the first one.
Absolutely.
Yeah, is there any word limit?
It's all in there. So yes, there is a word limit. Think of it as 1,000 words plus or minus 10%, plus commenting on others. So have a look at the assessment task and just check off. Don't forget to check out the rubrics. And I am very happy to do Q&A, talk about what the topics are. Also very happy, I will put it in when I circulate the videos, which I'm ahead of time on because I've done more than half of them from yesterday already. I will share a link that you can make a one-on-one time with me if you want to do that. And we will also, I'll make a couple of webinars available.